Hey everyone, it's David from Aventine here again for another edition of our quarterly review and outlook. We named this presentation Opposites Attract, as the asset class performance we've witnessed in Q1 of 2023 has been a near mirror image to what we saw for the full year in 2022. Let's have a look at what I mean. Here is risk asset performance for 2022. If we move from left to right along the graph, we see that all market cap segments were down in a tight range from -17% to 20%. Across sectors, it was technology and consumer discretionary who were weak, while energy was the standout performer. In the emerging markets, China, Taiwan, Korea, and Mexico stood out as the weakest, while Brazil was noticeably positive. Finally, there was weakness across all fixed income categories. Fast forward to Q1 of this year and we see significant changes. We see that large caps are significantly outperforming the mid and small caps. Meanwhile, technology and consumer discretionary are up double digits while energy and financials have suffered. Brazil has been weak, while Mexico and the Asian economies have done well. Finally, all fixed income markets have recovered nicely within a tight range. There was truly a market 180 at the New Year's Eve party. One of the most important events of the first quarter was the regional banking crisis which occurred in the United States. We thought it might be helpful to take a moment to explain exactly what occurred. Well, on March 17th, Silicon Valley Bank, the 17th largest bank in the US by assets, filed for bankruptcy. The result was a collapse in the US yield curve, as could be shown here illustrated by the 2- and 10-year US government bond yields. Between 2019 and 2022, Silicon Valley Bank, or SVB, saw massive deposit inflows. In fact, their deposit base nearly tripled over that time frame. When deposits grow, banks must use that capital to earn a rate greater than the deposit rate. SVB couldn't grow its loan book fast enough, and so it invested that money in mortgage-backed securities and US government bonds with longer maturities. Now, it should be noted that all banks do this. However, most have sophisticated hedging practices which removes the interest rate risk of holding these assets. SVB held these on the books unhedged. It wasn't long before the Federal Reserve began one of the fastest hiking cycles in history. The result was that the 3-month Treasury bill yield went from 0 to 5%. This had two impacts. One, it made holding deposits at banks far less attractive than investing in the 3-month T-bills for the consumer. And two, it significantly reduced the value of the fixed income securities that SVB held. Huge losses began to show up on their balance sheet, and in order to shore up liquidity, SVB announced that it was going to sell many of its securities and realize these losses. This caused clients to accelerate withdrawals, further exacerbating the liquidity issues. The fear soon spread to the other regional banks, and we can see the sector performance implications of it here, with 1-month average price movements of -50%. Banks are in the business of borrowing short-term and lending long-term, and so when the yield curve is inverted, it becomes difficult to earn net interest income. Even with the recent steepening, the US yield curve remains extremely inverted. It also shows you the extent to which it is uneconomical for individuals to hold large amounts of deposits at financial institutions and not earn the risk-free rate of 5% using 3- to 6-month T-bills. As we just mentioned, when the yield curve is inverted, the banking business model becomes stressed. As a result, lending standards often follow moves in the yield curve. This chart shows that when the 2s-10s curve inverts, banks tighten lending standards. This, in turn, drives negative economic growth. That is why many believe that an inverted yield curve doesn't predict a recession, but it actually causes one. And this is a major concern at the moment. Lending or lending standards is often what differentiates a hard or soft economic landing. If lending standards and the availability of credit continue to tighten, the probability of a hard economic landing increases dramatically. Unfortunately, we have already seen this begin to happen. Commercial bank lending in the 2 weeks ended on March 29th dropped $105 billion, which was the most on record back to 1973 when this data began being recorded. Unsurprisingly, a large portion of this was due to a drop in loan availability at the smaller banks. One positive takeaway is that credit contraction is a very deflationary force and could provide valid cover for central banks to end the tightening cycle sooner rather than later. The most recent CPI readings in both the US and Canada showed that both headline and core CPI are declining steadily. The US core CPI grew 0.38% in March, down from 0.45% in February, and was the lowest monthly print since November. Year-on-year inflation is still high at 5.6%, however. We have been saying for quite some time that shelter inflation is what to watch. It is the largest component of core CPI, and it fell significantly from 0.76% down to 0.56% month on month. This is one of the stickiest components of inflation, so seeing a meaningful drop is extremely encouraging. Perhaps more importantly, however, is that although year-on-year inflation remains high, when you begin to annualize the month-on-month changes, the data looks much more under control. In March, for example, the median good or service had an annualized price increase of slightly less than 3%, just above the Fed's target. This is a dramatic improvement from 2022. Investor Stanley Druckenmiller has famously said that once inflation goes above 5%, it has never come back down without the Fed funds rate exceeding CPI. Well, that gap has now closed, with the upper bound of the Fed's target above headline inflation. While we think it's possible that the Fed hikes another 25 basis points at the next meeting, the more likely scenario is that we pause from here. As mentioned earlier, commercial credit is contracting, and a second-order impact of this and a major focus of the Fed is higher unemployment. We have long argued in these presentations that the market will unwind job vacancies before we see a meaningful increase in the unemployment rate. It appears as if small business confidence indicators are pointing lower. In fact, NFIB survey respondents who say that this is a good time to expand are at the lowest level since 1980, and hiring plans are the lowest since 2017. It is clear that employment is also slowing. In fact, recent initial jobless claim numbers sent some minor shockwaves through the market. Initial claims came in above consensus at 228,000 versus expectations of 200,000. However, what's perhaps more interesting is that we are now starting to see meaningful negative revisions to previous readings. The previous week's jobless claims number was revised up by a whopping 48,000. The trend in cyclical jobs, represented by construction, manufacturing, trucking, and temporary help, are often the canary in the coal mine and lead other sectors. The trend in employment in the cyclical sectors is clearly declining, and we expect it to go negative shortly. When it comes to consumer health and the economy, other than employment, the most important asset class is housing and house prices. While relatively stable in Canada and the US so far, global housing is suffering dramatic losses. As a result, the concern in global markets have shifted rapidly from inflation to recession. Even the Federal Reserve is expecting a recession. In my experience, I have never once before heard the Fed document their expectation for a recession. However, in the most recent Federal Open Market Committee minutes, the group mentioned that the staff's projection at the time of the March meeting included a mild recession starting later this year. And as a result, the market hasn't been this fearful since 2011. Net short positions on the S&P 500 are above both the Great Financial Crisis and the dot-com bust. This makes the market far more resilient in the face of any weaker upcoming economic data. As we look ahead, we can see that the expectation for a recession and weaker economic data has led to a tremendous disconnect between what the market is pricing in and what the Federal Reserve is saying. Now, this is not abnormal, as the Fed would never predict rate cuts at this absolute level of CPI or unemployment, but these are not forward-looking indicators. The bond market is pricing in almost 200 basis points worth of Fed cuts over the next 18 months. This is by far the biggest amount of cumulative Fed cuts the bond market has ever priced in over the last 37 years. At Aventine, we are cautious that the market expectation for rate cuts in the short term are too extreme. And yet there are developing risks on the horizon beyond inflation, employment, and a slowing economy. The pandemic and the resulting work-from-home model has caused a significant and permanent shift in the way work is conducted. As a result, office vacancies have just hit a record at 16.4% and continue to climb. The commercial real estate mortgage-backed security market is pricing in significant distress at these levels. Another issue is where these commercial real estate loans are held. They are disproportionately at the regional and smaller banks with assets under 100 billion, as this chart shows. This could result in a debt crisis related to real estate that will never be used. New research suggests that the vacancy rate for commercial office properties could reach 55% under certain scenarios, further exacerbating the stress on the banks. Now, as we get into the Q1 earnings season, the market's concern revolves around margins. According to Goldman Sachs, net income margins will take the biggest hit since the pandemic lows this quarter. When we compare this to history, this would suggest that we are clearly in recession territory. Actively managing exposures is extremely important during turbulent times like these. The reason for this is the extreme dispersion that we're seeing in the market. We can see that in this chart. The materials sector of the S&P 500 has an expected EPS decline in Q1 of negative 32%, while the industrial sector is expected to grow earnings by 11%. Semiconductors, consumer durables, and apparel look particularly vulnerable here in the short term. In aggregate, earnings per share across the S&P 500 is expected to be negative 7% in the first quarter. It should be noted that this could provide a base on which to grow, as earnings are expected to re-accelerate in the second half of the year. Remember that markets are forward-looking and tend to front-run economic data. It is essential to take advantage of any idiosyncratic dislocations over the next few months. It should also be noted that since we've put this presentation together, earnings have been significantly better than expected, with year-on-year revenue increasing nearly 6%, while earnings per share has only been down 1.2%. With the market so negatively positioned, now is not the time to be overly bearish. While there are obvious and significant differences across market caps and style factors, the market, by standard definitions, is not overly cheap. The rule of 20 suggests that markets are generally fairly valued when the sum of the PE ratio and CPI equals 20. The current reading for the S&P 500 sits at 25, suggesting there is potential for some near-term downside. In recent memory, however, the most important factor impacting risk asset prices has been liquidity and the Fed balance sheet. In response to the regional banking crisis discussed earlier in this presentation, the Fed balance sheet has expanded by over $400 billion in 3 weeks. This has set the stage for conflicting public sector versus private sector liquidity. Central banks have expanded their balance sheets while commercial banks have been tightening them. We believe the Fed will not be actively selling down its balance sheet, as this would further distort financial markets beyond what it has already done. Now let's put it all together. Despite a challenging backdrop, both the S&P 500 and the TSX have both posted positive returns for the past 2 quarters. The Fed finally managed to break something, and it was the regional banking sector, and were forced to inject liquidity into the market and expand their balance sheet to the tune of $400 billion over 3 weeks. This was a direct result of the Fed's actions by raising interest rates so quickly, as deposit rates became uncompetitive with short-term treasuries and long-duration assets suffered their worst decline in years. Banks have responded by reducing lending by nearly $105 billion in the 2 weeks ended March 29th and continue to tighten lending standards. Inflation continues to decline as the median good and service price in the CPI basket had an annualized inflation rate of slightly less than 3%, just above the Fed's target. Our concerns revolve around corporate earnings, lower demand from reduced savings, and commodity inflation, especially given aggregate valuation levels of the market. We continue to measure the economic damage through the unemployment rate and closely monitor the commercial real estate sector. The risk-reward on longer duration fixed income assets remains attractive as corporate profit uncertainty remains very high. Our equity allocations are focused on higher quality companies with both organic and inorganic growth opportunities, as well as idiosyncratic dislocations in the market. At Aventine, we maintain that the risk of a recession in 2023 is more manageable and more priced in than the inflation shocks that we saw in 2022. We are not advocating for full risk on and hold higher cash balances than average in client accounts. I want to thank you for taking the time to listen to this presentation, and please don't hesitate to reach out to any one of us if you have any questions about the market, what we've discussed, or your portfolios. Thanks again.